In this video, I want to talk about how high interest rates crush valuation. This will be a complete masterclass. So at the end of this video, you will understand the impact of interest rates on valuation and why do people panic when you have high interest rates. Why do people panic and go out of small caps, leveraged companies, the importance of debt, the comparison, risk reward, risk-free rate, everything. This will be a complete masterclass, and let's start. In case this is your first video in this YouTube channel, welcome. My name is Christophe Nour, and I've been investing in the stock market for almost a decade now with a performance of 25% per year. And okay, let's start. This is for high interest rates. So interest rates, that's the cost of borrowing. That's the fixed rate by the Fed, the Federal Reserve, Jerome Powell. You know the drill, you know how it works. And we have the equivalent in Europe with the ECB, European Central Bank, that fixes the interest rates to banks that fix the interest rates to us. So everybody is impacted by the interest rates, and you have a reverse correlation between high interest rates and valuation. So normally, most of the time, if interest rates are up, if you have this chart and you have some high interest rates, it's very likely that the PE ratio for the S&P 500 will look like this. Warren Buffett said, interest rates is to stocks what gravity is to matter. And in this video, I will explain why. Okay. Now, where should I start? Let me start with some basic valuation stuff. Okay. How do you calculate the intrinsic value of a stock? Maybe you look at the PE ratio and say, okay, absolute valuation, relative valuation. You can also do a DCF, a discounted cash flow model. It's a tool to find an intrinsic value for a stock. So you have your DCF. What is the formula for a DCF? You do the sum of the free cash flow of the business, free cash flow year 1, free cash flow year 2, and you divide this stuff by the interest rates, like 1 plus R, which is the interest rates. 1 plus R, which is the interest rates, and this is for year 2, so you do square, and then you continue free cash flow year 3 divided by 1 plus R 3 here, and you continue like this. And you have this free cash flow. Let me put free cash flow of the year N, and this is 1 plus R N. Very well. So this is your formula to free cash flow. You discount the future free cash flow. You estimate the free cash flow of the future for a company, and you discount them back to present value. This will get you a DCF, and this will help you understand the intrinsic value of a business. If R here is 0, then the DCF is very high. If R is 0, you have free cash flow 1 plus free cash flow 2. That's amazing, and the DCF will be very high, and you have extremely high valuations. If R is 0, if the interest rates are 0, the DCF can go to the moon, as we say. DCF can go really high, and this is what happened for a lot of companies in 2020, 2021. I'm sure you have countless examples in your mind of companies that were not that great, but the stock price went up a lot in 2020, 2021 because we had interest rates at 0%, okay? And now in 2022, interest rates went from 0 to 5%, and these bad companies crashed completely. So that's it. If the interest rates is increasing, you have the denominator that is increasing, and that's putting a drag on all this stuff, and that's reducing your DCF. So the fact that the interest rate is going higher is reducing your DCF, is reducing your intrinsic value of a business, hence the stock price. If your intrinsic value is collapsing, the stock will collapse. And everybody knows this on Wall Street. They all do their DCF, and they are all aware of this. So now we have some rumors that interest rates in 2025 will not go down, they will be stable. Maybe they will go up in 2025 if inflation picks up. So in their model, Wall Street analysts estimate sometimes that R will be at 5%, sometimes 6%, and the DCF is adjusted. So now you have your first answer. Why is valuation going down? It's because of higher interest rates. That is putting a drag on the DCF and is lowering all stock prices, hence the valuation. Now let me explain another thing. You have strong companies in the market and you have bad companies in the market. You have companies with a lot of debt. You have companies with no debt. This is a very little difference when interest rates were at 0%, and this is a very high difference when interest rates are at 5%. For the past few years, like the past decade, interest rates were at 0%. So it was almost free to get some leverage. It was free to invest in yourself. You get some cheap leverage, cheap debt, and you invest in side projects. And that's okay if you are a mediocre business model. If you have some debt with the low interest rates, that's okay. You will not go bankrupt. Sometimes we saw bad companies taking a lot of debt and there was no repercussion. I was fine. They didn't go bankrupt, so they survived. And they were similar to the companies with no debt. You can argue that companies with some debt propelled their earnings and their stock prices. But now this is different. Now interest rates increased to 5%. So that's 5%. So if you have a bad business model and you borrow at 5%, that's quite bad. That's quite bad. I mean, your opportunity cost is now 5%. If you borrow some money to fund a project, if you borrow at 5%, you need a reinvestment rate of 5% to get your money back. So you need some efficiency, some good return on capital. If you are a bad business model, if your return on capital is 2%, you do 5% minus 2%, you lose money and you will go bankrupt. So now bad businesses will start to struggle. And you know where you have a lot of bad businesses? You have a lot of bad businesses in the Russell 2000. This is an index like the S&P 500, the Nasdaq, the Dow Jones, focusing. I mean, you have a lot of small caps and mid caps, and these companies are not that good business models. These companies, a lot of these companies are struggling, are small, and they have debt. So they are small and they can't negotiate the interest rates, the debt they have, and they use some debt to survive. And now interest rates are high. Debt is not cheap anymore. Debt is not free anymore. These companies, these small companies in the Russell, will struggle because they rely on debt to survive. If debt is expensive, they will die. You have a lot of companies in the Russell 2000, 3000 that are greatly impacted by the change in interest rates. And that is also another way of answering this question. High interest rates will be a huge drag on valuation for the Russell 2000, Russell 3000 also. So second way of answering this question, if you are small, you can't negotiate your rate. High interest rates will push your valuation down if you are a small company. That's why you have this impact on the markets, high interest rates. And you see that the S&P 500 is going down because of high interest rates. And the Russell 2000 is going down by a lot more because of this impact. Small companies suffer more because of high interest rates. So if you wanted to assess the drop in valuation, expect valuations to drop drastically for small caps. And small caps that are leveraged are likely to drop like a rock. I mean, you need a solid business model to survive here. So that will be a big move for the coming years. Small companies will suffer greatly. And let me check Let me check. Okay, very well. Now, as a global basis, let me not talk about small caps anymore. As a global basis, you have companies that use debt to fund projects. And these projects are likely to increase revenue, earnings, create value for shareholders, etc. Now that your cost of borrowing is not 0%, but it's 5%, your opportunity cost is higher. Now, if you are a company, a public company, and you have some cash to invest, what do? Imagine you have some cash in the balance sheet. You are a public company, you are Apple or any big company with a lot of cash. Either you stay in cash or you invest the cash in short-term bonds that will give you 4 or 5%. So invest in, or you reinvest in yourself. Your opportunity cost is now 5%. So what do? If you have some high internal rate of return, that's the way to go. If you are Amazon, if you are Adobe, if you are Salesforce, you have a lot of tailwinds, you invest in AI, that is worth it. So for young companies or technological companies, it's maybe worth it to use the cash to invest in this one. That's your opportunity cost. Now for major companies that don't have much reinvestment opportunities, I would say they will go and use the cash to invest in short-term bonds. That would be how I would see the situation. They can't stay into cash because of inflation. They will just invest in short-term bonds. And the way you see this change of capital allocation policy, this will have an impact on performance. This will have an impact on the stock prices. This will have an impact on the valuation. You remember I started this video with the DCF, like estimation of future free cash flow. I guess that the free cash flow in the future will increase more if you reinvest and grow, like Amazon, compared to this situation in red if you are Coca-Cola and you don't have much reinvestment opportunities. So the free cash flow will be impacted in the future. So the DCF will be impacted. So the valuation will be impacted. High interest rates will make us differentiate between slow growers and fast growers. And this will have an impact on free cash flow. And everything is about free cash flow. So this is your cost of borrowing, but also your opportunity cost. And now companies have to choose. You can't do nothing with the cash. You have to do something with the cash because now we have inflation. So companies have to choose what to do with the cash and reinvest or not. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now I will give you two other things. Let me put this. Okay. Now we have talked about companies that have some debt. Some companies have a lot of debt, by the way. And in the future, in 2025, 2026, they will generate some revenue, earnings, free cash flow. What do you do with your free cash flow? Either you, how can I write this? Companies with debt will generate free cash flow. What do you do with the free cash flow? Either you pay down your debt, you repay debt, you use your cash to repay your debt, or you reinvest inside the business, or you use your own free cash flow to reward shareholders. What do you do with the free cash flow? And similarly, management teams will have to decide. What do they do with the cash? I know a lot of companies, great companies, but they have debt, okay? They have some debt and they are assessing the situation. Either they have great reinvesting opportunities and they will reinvest inside the business and you cross your fingers and you wish for the best, or you play safe and you repay your debt. The cost of rescheduling your debt with the different maturities can be quite high. So if you, I don't know how to say this in English, if you reuse the same debt to have a constant debt, you will not have a debt of 0% right now, you will have a debt of yielding 5%. So the cost of rescheduling your own debt is 5%, which is maybe not great. So maybe you want to pay down your debt first. You want to be safe, especially since now in 2025 and future years, people seem to expect a recession. And if you are a recession, you don't want any debt. You want to be lean. You want to be sharp. So sometimes if you are a CEO of a company, you want to play safe and say, you know what, let me slow down on growth. Let me not reinvest a lot. Let me play safe. I expect a recession in 2 years. Let me just repay the debt first to lower our debt hurdle, and then we will reinvest back. But some companies will not be comfortable having high debt now that interest rates are high. So they will focus on repaying the debt first, using all the free cash flow to repay the debt. And imagine you are a shareholder of this company. You bought the company 2 years ago because of the growth, and now they will not reinvest anymore. They will just focus on repaying the debt. So some shareholders will be disappointed. Some shareholders will sell out of this stock, and the valuation will drop because the capital allocation policy will have changed. Oh, too bad for you. Companies are like species. They change. They evolve, different environment, different evolutions. So the same way Mark Zuckerberg out of Facebook changed his lifestyle, his outfit, a complete change in personal branding, some companies change. And maybe you invested 2 years ago because of growth, and now there is no growth opportunities, and they repay debt, and the company will slow down drastically, and the valuation will be reduced accordingly. Okay, so that was for your first alternative. High interest rates, repayment of the debt, low growth, valuation down. Or some companies may continue to reinvest in the business. You invest in the business and you play with fire because you have a lot of debt. And that's a double-edged sword. Either the growth is amazing and it works fine, or you fail because it was a bad opportunity and it turns out to be not that great, and that will be terrible for future earnings growth, terrible for future revenue growth, and valuation will drop, but later. And the third reason, the third opportunity you have as a CEO of a company is to reward shareholder. I would not like this situation. If you are a company with a lot of debt and you have the opportunity to repay your debt or reinvest or reward shareholders, I would hate to see the company reward shareholders. I think that's very risky. That's not at all the best use of capital, paying dividends or buybacks. I don't like this at all. And speaking about buybacks, by the way, since we are here, some companies are very good at financial engineering. So they borrow debt, what they did in the past. How can I write this so that you understand? They have debt at 3% at the time, and they buy back their own shares. They repurchase their own shares at an earnings yield of 3%. That means a PE ratio of 30. If you borrow at 3% and you buy back your own shares at what's that? Okay. What did I write? I wrote 30. No. 3% earning yield. Sorry. If you borrow at 3% and you buy your own shares back at 3% yield, do you really create shareholder value? Open-ended question. Back to you on the comment section below. That depends. And some companies are great with buybacks. Some companies are lame with buybacks. And now that the debt level is 5%, to have the same situation, you need an earnings yield of 5%. And an earnings yield of 5% is what? A PE ratio of 20. So you only have to buy back your own shares at a PE ratio below 20. You see this kind of change in mindset, formula management knows how to deal with this. And some companies will choose to do buybacks regardless. Some companies will change their capital allocation policy and repay the debt. And all of this will affect the future free cash flow of the business. And it revolves, it goes back to the thing I started the video with, the DCF. If you don't focus on free cash flow in the future, free cash flow will decrease, DCF will decrease, intrinsic value will decrease, and the stock prices will decrease. So that's very important. A change in interest rates completely changes capital allocation policies. And now, as a global basis, high interest rates are not good for stocks, because now you can get a safe, if the interest rates are 5%, you can get a safe 5%, and a lot of people will like a safe 5%. And you compare it with the earnings yield of stocks. Okay, now the PE ratio for the S&P 500 is around 30. That means an earnings yield of 3%. Earnings yield 3%. So some people compare the safe 5% with the earnings yield of 3%. And they say, you know, as an opportunity cost, it's better to be invested in bonds. Safe bonds, I will have 5%. You can say yes, but the earnings yield will not always be like this. The earnings of the S&P 500 will grow, so you have a growing pie. Yes, you have everything can be heard here. But some people are not comfortable having an earnings yield of 3% for the S&P 500. Some people don't like a PE ratio of 30. They think it's too expensive. Some people are near retirement and don't want to be at risk with stocks. They want to play safe. So they sell out of stocks and they go into the safe 5%. Some people just prefer to have a 5% yield and sleep well at night. We are humans after all. We want to avoid the stressful situations, and some people prefer this. And as interest rates go up, this safe level will increase. Now imagine that instead of having interest rates of 5%, we have a interest rate of 8%. Imagine, I mean, we had this situation in the 80s. We had double-digit interest rates, so that was fine. Imagine that now interest rates are 8%. Do you still invest in stocks? That's a very good question. A lot of people will say, no, I want to save 8%. That's fine. I'm okay if inflation is 6%. I mean, I have 8% for sure in my bank account. I'm safe with that. And as interest rates go up, more people will be scared. More people will prefer to invest in safe bonds, to have a safe 8%, even 9%, 10%. So you compare the risk-free rate of the interest rates at the moment, you compare it with the earnings yield of the market. And as markets become expensive and the interest rates are going up, people are shifting. People are selling their stocks to invest in bonds. You have this phenomenon for individuals, like you and I. We assess the situation and we say, yeah, maybe it's safer to invest in bonds. You have this situation for big funds that are playing safe. You have this situation for companies. You have this situation for everybody. And this may lead to large outflows from the stock market into the bond market. And that affects the risk-reward ratio of the market. And obviously, because people are selling out of stocks, it will drag valuation down. It will cause valuation to drop significantly. So bond yield, earnings yield, that's a key difference. And after all, now we have interest rates at 5%. That is our opportunity cost. Our opportunity cost is having a safe 5%. If you think you can invest in something, whether it's real estate, whether it's a Rolex, whether it's art, anything, it has to yield more than 5%. Real estate, anything, stocks. If you think it can't give you 5%, don't do it. Don't do it. For stocks, people are betting that the growth will continue. Now in 2025, we have the Magnificent Seven driving the stock market. Great companies, great earnings growth, great free cash flow growth, great stuff, amazing management. So people are still optimistic about the stock market. People are still optimistic about the S&P 500, and they think that the Magnificent Seven will continue to grow. So I don't see this shift as being major at the moment, because people are kind of euphoric, believing in these companies, and we will see if they are right or not. But the moment it turns, it will be bad. The moment it turns and the Magnificent Seven is not magnificent anymore, people will rush into this safe haven of having 5%. For the moment, these companies are in a great shape. Apple, Amazon, Google, Meta, Nvidia, great shape, great catalysts for growth. So people are still betting on the stock market and the 3% earnings yield because they think earnings will continue to increase. But what do you say? Nobody knows, actually. Nobody knows. You can hear and listen to some stuff on the internet, but actually nobody knows what will happen. Nobody has a crystal ball. It's just a matter of risk reward. Some people like to be a little bit more risky and invest in an earnings yield of 3%, thinking that the companies will continue to grow. And some other people play it safe. At the moment, Warren Buffett, with his conglomerate Berkshire Hathaway, has sold some stocks, including Apple, and most of the cash is in a safe 5%. Most of the cash is invested at a 5% yield, and it's fine. But Warren Buffett is not a retail investor. That's a big conglomerate that has to invest big sums. So they have a size issue. They can't invest in stocks that are famous on Twitter, YouTube. That's too small. That's too small stocks, too small companies. So they don't have a choice, and they are forced to put 5% yield here. But we will see. Big funds, everything. Now you know. High interest rates lowers valuation for many reasons. Change in capital allocation, change in policy, DCF, growth rate, etc. And it's all about an opportunity cost here. Now the opportunity cost is 5%, and if interest rates continue to go up, people will compare the opportunity cost 6%, 7%, 8%. So that's it for the interest rates and valuation masterclass. I hope you've liked it. Please leave a like and subscribe if you want more classes like this. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.